Hello, friends. There are 3 quiet gaps in your national insurance record that could be shrinking your state pension right now, and the DWP will never ring to tell you about a single one of them. 2 of them can be fixed for free, 1 of them was the government's own mistake, and all 3 are running out of time. Find the one that applies to you, and by the end of this video, you will know exactly what to check and what to do about it. The state pension is not a flat promise that arrives in full just because you reach the right age. It depends entirely on your national insurance record, what the government calls your qualifying years. For the fiscal year 2026 to 2027, the full new state pension is £241.30 a week, which adds up to £12,547.60 a year. To get the full amount, you need 35 qualifying years. If you have fewer, your weekly payment is reduced in direct proportion. You need at least 10 qualifying years to get anything at all. A qualifying year is a tax year where you either paid enough national insurance through work or received a national insurance credit. A credit is the government's way of saying, this year counts, even though you weren't paying NI yourself. Credits are added for things like caring for a child, claiming certain benefits, or sometimes when you're out of work. Most people assume their record is complete, especially if they've worked most of their lives or cared for family. But a single missing year can reduce your pension by around £6.89 a week, over £350 a year, every year for life. Many people and their families helping them only discover gaps when the first payment arrives short. The government does not check or warn you if a year is missing. That's why understanding how your national insurance record works is the first step to protecting your pension. Next, we look at the first hidden gap, one that has quietly cost thousands of families money they earned decades ago. Home Responsibilities Protection, or HRP, was set up to make sure parents and carers didn't lose out on their state pension just because they spent years looking after children instead of working. It covered anyone who claimed child benefit for a child under 16 between 6 April 1978 and 5 April 2010. In theory, every year you claimed child benefit in that window should have been protected, meaning it would count towards your national insurance record, even if you weren't paying contributions through a job. That's what the government promised. But in practice, something went badly wrong. For claims made before May 2000, child benefit records were not always linked to the right national insurance number. Without that link, the HRP credit never landed on the person's record. Most people affected were women who claimed child benefit in their own name, but the system failed to match their details. They carried on, believing the years spent raising children were protected. The reality only surfaced decades later, when pensions arrived hundreds or even thousands of pounds short. It took until 2021 for the Department for Work and Pensions to admit the scale of the problem. By then, around 194,000 people had been identified as missing HRP credits, with an average loss of about £5,000 each. The government originally set aside £1.2 billion to repay those affected. But by 2025, that fund had been slashed to less than £30 million, as officials claimed most eligible people had already come forward. In truth, many still have no idea they are missing money. Sarah from Manchester, born in 1955, claimed child benefit from 1982 to 1994 for her 2 children. She later discovered a 4-year gap in her national insurance record, years she had spent caring at home. After submitting the official CF-411 form, her record was corrected. Her state pension forecast jumped by £5,200 and her weekly payment rose by £13 for life. Her case is one of thousands, but most people only find out if they check for themselves. If you or someone you know claimed child benefit for any year between 1978 and 2010, the next step is simple. Check your national insurance record for missing years. If a gap appears where you are caring for a child, you may be owed a pension boost. The official gov.uk route is to download the CF-411 form and submit your claim. The sooner you check, the more likely you are to recover what's yours before the repayment pot runs out. Specified adult childcare credits work differently from most benefits. They are a transfer, not a handout. If a parent is working and receives child benefit for a child under 12, they can pass their national insurance credit to a family member who looks after that child, most often a grandparent, but it can be any relative or even a close family friend. The scheme began on 6 April 2011 and can be backdated to that point, so years of unpaid family care since then may still count towards a full state pension. The rule is simple. The child must be under 12 during the year in question, and the carer must provide unpaid care for at least a third of each week. So, for example, looking after a grandchild while the parent is at work for a couple of days. The parent keeps their child benefit, but agrees to transfer their national insurance credit for that year. This credit lands on the carer's record as a qualifying year, adding around £6.89 per week, about £358 a year, to their state pension every year for life. Most people never hear about this option. DWP and HMRC do not write out or call to explain it. The only way to get these credits is to know the rule, check your record, and ask for the transfer. The official route is to fill in the CF-411A form, available on gov.uk, with both the carer's and the parent's details. If you or someone you know has cared for a child under 12 since April 2011, check today. Credits can still be claimed for past years, but only if you act before the window closes. John from Birmingham, born in 1948, spent 8 years caring for his grandson, while his daughter Lucy worked full-time. Like so many grandparents, John never thought of himself as a carer. He was simply helping family. But under the specified adult childcare credit scheme, every year he looked after his grandson, while Lucy claimed child benefit could be turned into a qualifying year on his national insurance record. The catch is, hardly anyone claims. Around 9 in 10 eligible grandparents miss out, simply because the government does not publicize the rules or contact those who qualify. The only official way is through the CF-411A form, which both the carer and the working parent must complete. Lucy had to agree to transfer her national insurance credit for each year John provided care. Once the paperwork was done, John secured 8 qualifying years he would have otherwise lost. Each one now adds about £340 a year to his state pension for life. That's a £2,720 annual boost, over £52 extra every week. For families like John and Lucy's, these credits can quietly transform retirement income, but only if someone knows to ask. Even after using all available family credits, though, some people will still see gaps on their national insurance record. The next section reveals how those final missing years can cost thousands if handled the wrong way. For any years still missing after checking for home responsibilities protection and specified adult childcare credits, there is one last route: paying voluntary Class 3 national insurance contributions. This is the paid fallback, only for genuine gaps that cannot be filled for free. For the 2025 to 2026 tax year, each year costs £960. In the 2026 to 2027 tax year, the price drops slightly to £900. Every year you buy adds about £6.89 a week to your state pension, just over £358 a year, paid for life. The normal rule is that you can pay for up to 6 past tax years, covering any year from 2020 to 2021 onwards, if you act before April 2026. There are no automatic reminders or warnings from the government about missing years or whether you really need to pay. That is why it is essential to check your national insurance record first, claim any free credits you are owed, and only then consider paying. Paying for a year you could have had for free is money lost, not money invested. The next section shows how easy it is to fall into that trap and how to avoid it. Mary in Leeds, age 62, thought she was doing the right thing. After spotting 2 missing years on her national insurance record, she paid £1,800 for voluntary Class 3 contributions, £900 for each year, hoping to secure her full state pension. Months later, a historic correction landed on her record. It turned out one of those years should have been covered for free by a home responsibilities protection credit she earned decades earlier. But by then, her payment had already been used in the official calculation of her pension. When she asked for a refund, the Department for Work and Pensions refused, saying the contribution was now part of her entitlement. Mary's story is a warning. The real risk is not the option to pay, but paying before every free credit has been checked and claimed. Always check your record and speak to the future pension center before sending a penny. Start with the official gov.uk personal tax account. Once you are signed in, look for the National Insurance Records section. This page shows every tax year on your record, with clear marks for any gaps, years where you have not paid enough, or have not received a national insurance credit. Next, use the State Pension Forecast tool to see your likely weekly amount. This estimate is based on your current record and shows if you are on track for the full £241.30 a week, or if you will fall short. Before making any payment, ring the Future Pension Centre on 0807 310 175, Monday to Friday, 8 a.m. to 6 p.m. Their job is to check whether paying for a missing year will actually boost your pension, or if you could fill the gap for free. Take these steps yourself, or show them to a parent, partner, grandparent, or adult child who helps with finances. The difference could be thousands of pounds over a lifetime. Right now, over 200,000 pensioners are owed back payments simply because no official ever explained these hidden rules. The state pension system rewards those who check for missing qualifying years before the deadline. Your action today can mean thousands more in retirement. Subscribe for updates before the next rule quietly changes.